joined by Shirish Godbole, CEO, and Quaiser Parvez, CEO, KRT Reit. Hi, morning, and welcome to the show. And Shirish, I'll come to you first because the quarter and the H1 gone by seems to be improved in terms of occupancy for you. But the main question, how sustainable do you think it looks like now?
Thank you for having us, me and Kaiser. Yes, we've had a strong quarter, and we feel very comfortable and positive as we look forward. Indian markets continue to be, experiencing a lot of demand, both from the GCC side of the world as well as the domestic occupier side of the world. So when you put that together, we have good sort of inquiries and discussions with tenants. We think our occupancy will improve from here, and we look forward to the second half of this year.
All right. Hi, gentlemen. Morning. This is Shrishti also joining in. Mr. Parvez, just wanted to have your take on the yields. Help us understand what's the outlook on your yields. Are they likely to sustain at current levels, or are there any risk that this number can fall from the current levels in the times ahead?
First of all, thank you so much, Srishti, for having Shirish and I. And as regards to the yield, I think we have a very positive outlook on how this all stacks up in the second half of the year. Our portfolio occupancy has moved by about 340 bips over the last 2 quarters from March to now in the first half. And we are sort of, focused on an occupancy of 93 to 94%. And with that, we are focused on delivering a 7.6 annualized return to our unit holders, and we feel that that should be very much achievable as part of our projections.
Right. Shirish, let's also focus slightly on the rental growth aspect. We really want to understand what's the trend looking like and what should we expect in FY26, FY27, Shirish, and also, the CAGR rate for 2 to 3 years if possible.
Yeah, so I think a couple of things, right? Number one, again, like I said, the demand is very solid. I think Kaiser will walk you through specific sort of rates in the different markets, but whether it's Mumbai or Hyderabad and Bangalore, all three, which are the main markets we're in, are experiencing good demand and therefore rental appreciation and growth. Supply, at least in the foreseeable future, is muted. And that helps because you have less supply and more demand, and obviously rents sort of tend to go up. And as far as CAGR, we're very positive for our future growth because there are 3 or 4 different avenues, right? Number one, our rents in place are 20% plus below market. So as 1.5, 1.7 million, I think that's the range of square footage that comes up each year, comes up for renewal and for releasing. We are very confident we can achieve and take that kind of appreciation, 20% every time a lease comes up. So that's exciting and positive. We also have 1,002,000 square feet under development that is going to get delivered in the fourth quarter of this year. So by March 2026, we have development that we can take on, and so on and so forth, right? We're also looking for acquisitions as we go out and do inorganic acquisitions. So when you put that all together, we continue to think that we can grow this, distribution that we have over a period of time, and are optimistic as we look to FY27 and FY28. Kaiser, maybe you can give specifics on the rents and appreciation by market.
Just to put this in perspective, we have done 1.8 million square foot of leasing in the first half. And that has come at a blended spread of 29%. And we have been able to really actualize 8% premium to the market rent. So and that's exactly to the point what Shirish was making, that our market rents are 94 rupees as compared to our in-place rents are 94 rupees as compared to the market rents of 115 rupees, which is a 22% difference. So we think that we are very well positioned to able to actualize those mark-to-market potentials as we go along from one quarter to another quarter, especially in a very buoyant demand cycle and a very tightening phase of the Indian office real estate.
All right, but along with that, Mr. Parvez, help us with the outlook on the debt levels as well. Any plans to reduce that? Any risk on refinancing? And what's the outlook on the fall in the debt cost?
Yeah. So, in the first half, we have already booked a significant drop from the 8.6 to 7.4% in our rate of interest for the debt. Having said that, we are the lowest LTV across all our peer group of 18% LTV only in terms of our total debt exposure to our asset value. But with that being said, we'll continue to sort of look at the whole declining interest rate scenario. A significant part of our debt is in the floating stage, and we'll continue to explore the possibilities of the optimal mix of fixed plus interest in terms of what works out best in order to ensure that our tax efficiency of our dividend structure continues to be as optimal, because keeping the right stage of or the right amount of debt is equally important to ensure that we give a most tax efficient dividend payout to our unit holders.
All right, gentlemen, I think that will be all. Thank you so much for taking time out and speaking to ET now on the result fronts. Thank you.
Thank
Thank
you.
you.
Thanks for having us.